This is my ultimate trading strategy that I figured out after 4 years, that all you need is a simple box in the market that will tell you everything, and yet nobody talks about it. So this simple strategy achieved me multiple 5-figure months, and alongside with that it's giving me insanely high win rate, and the best part is that you only need 90 minutes a day. So in this video I will share with you my full one box strategy step by step, and then I will also show you live examples, so by the end of this video you can know how to execute it yourself. So with all of that being said, let's get into it. So the first thing that I want to show you is the monthly profit. So you can see right here almost $30,000 in profits, and you can see that win rate is above 85%, which is insanely high. And right here you can see all my wins and all my losses with this model. So now that you know that I'm not teaching you something that I don't use, let's get straight into it. So let's start right now with what the box is and what exactly does it tell you. So first thing of all, it tells you what the most important liquidity levels are in the market. So we are going to learn why are liquidity levels important and how you can basically spot them on the chart. The second thing is it will actually tell you where market does stop out other traders. So we are always going to look for those manipulations of that box, and then with that we are going to know exactly where the traders get stopped out and where does market basically do a liquidity sweep. Then after that we are going to get precise entry. So we are going to get an entry where the move starts, and then we can just hold the position till we actually get the entire move in a certain direction. So we will know exactly where the move of the market will actually start, so we can actually enter the trade, put our stop loss, and wait till we actually expand into the direction that we want to see. So what does one box, or we can call it one candle strategy, consists of? So the first thing, we need that one box. So we need to know how to draw it, which I'm going to learn how to do it in the ranging market and in the trending market. So basically when we have that figured out is how to draw it, we are going to mark out range highs and range lows of that box. So that is going to tell us exactly where the big banks and other large market participants are placing their buy and sell orders. So big banks and market makers will place their orders in these areas of significance, which is basically where other people get stopped out. That is where market maker, big banks, and us are going to enter the market. So let's right now learn how to draw the one box in a ranging market. So this is the first kind of market where we are not either going to the upside or we are not either going to the downside, but we are kind of ranging in the same spot. So the first thing that we need to understand is how do we actually draw the box. So the point is, in the box we want to spot where the most liquidity lies. And what the liquidity is, it is every single high and every single low in the market. Because why is that? Because at every single high and low in the market, like these highs right here and these lows down here, we know that at them there is a lot of stop losses. Why is that? Because you can even ask yourself, when you enter a position, where do you place your stop losses? Either at high or at low. So we know that 99% of traders are going to place their stop losses at highs and lows. So the market makers, the banks, and the institutions, they're going to manipulate the market and sweep highs and lows in the market. So our one box for the ranging market is going to be above the stacked highs or below the stacked lows. So for example, since we have a lot of lows right here, bottom of the box, and then right here we have our highs, so this right here is going to be the high of our box. So basically later on you will learn how we will wait for the manipulation of this box, either like this or like this, and that is precisely going to tell us where to enter the market, where to exit the market, what to target, and basically where to put your stop loss. And of course we are going to have some entry criteria that we are just going to wait for, and once we see them in the market, all we do is we execute a position. So everything is rule based. So now that you know that one box is going to be on highs and lows in a ranging market, let's learn how is it going to look like when the market is either uptrending or downtrending. So basically when the market is trending, so for example this one right here, we are making structure to the upside. As you can see, it is really clear that we are just breaking structure to the upside and just displacing to the upside. So right here when we know that we have a certain direction, so for example right here we are clearly uptrending, our one box is not anymore going to be a high and low in the market, it is actually going to be a fair value gap. So what a fair value gap is, it is a 3-candle formation like this when we have an imbalance in the middle. So for example, this right here is a fair value gap, because you can see right here the wicks are not crossing over each other, and this is going to be something that we mark out and wait for a retest to then of course target a break of structure to the upside. So for example, here we also have the one box when the market is trending, so it's a fair value gap, so we will always wait for a retracement into this fair value gap, and then after we get the retracement into it, we will get our entry model somewhere right here, and then of course we are going to proceed to target highs. You can see also right here we have a fair value gap, and then when we enter it we get a reaction to the upside, and of course we get the break of structure to the upside. Here the same thing, we returned into a fair value gap, and then followed by that we just kind of made a break of structure to the upside. So these right here are the one boxes when the market is ranging, and this right here would be the new box that we would just be waiting for the retest. And the really cool thing is that we get the retest of one box, we are going to look for something specific right here that is going to tell us that market is for sure going to reverse and of course target some kind of structure to the upside or liquidity points. And also candlestick theory that is going to help us actually read the market direction, which is going to tell us, are we for sure in the uptrend, in the downtrend, or are we likely to reverse? These candles are going to show us exactly that. So these are the highest probability candles for a continuation of the trend. And why is that? Because you can see that, for example, market opened right here at the bottom of the body, then after that we really displaced to the upside without any hesitation and closed right here. So that is trade telling to us that at the moment buyers are in control. Then this right here is a really bearish candle, which is candle to the downside, and you can see we opened up here and then closed right here. So that is telling to us that market moved really hard towards the downside without any hesitation and closed all the way right here. That is telling us that market is really likely to continue going to the downside, and this candle is telling to us that the market is really likely going to continue to the upside. So for example, right here you can see that we retested a box right here. So we are in a uptrending market, we retested a box right here, so we retested a fair value gap right here. After that you can see this high, and you can see how we broke structure. We didn't wick above it. If we wicked above it, that will mean for us that at the moment uptrend is not as strong, and then after that we made a retracement into the one box right here. So you can see at this moment we made a new box right here that we retested, and you can see how we swept this low. So we basically would have gotten an entry to the upside right here. Then right here you can see that we got another box that was also retested at a moment right here. And then what the market did is market actually came right here and then swept this low right here. But why didn't the trend reverse to the downside when we took out this low? Because you can see that we just wicked below it and we didn't really close with any kind of strength to the downside. So after that you can see how the market is placed to the upside above this high, closed really strongly, so we can expect a move to the upside. And you can see the same thing, we just kind of reversed and started really hardly going and displacing to the upside, which just lets us know that we are kind of going to continue making structure to the upside. So we know how the candlesticks that are going to continue the trend are looking. So right now these are the highest probability candles for the reversal of the trend. So when we have these candles with a huge wick to one side, we know that market tried to go down but then ended up rejecting and closed to the upside. So this candle is really likely to reverse the market to the upside. Then right here this candle tried to go to the upside but rejected really hard and closed to the downside in the end. So this candle right here is going to for sure push the market to the downside. So basically these are candles that are going to tell us that reversal is happening, and it's looking something like this. So for example, in the market we see right here that we have a strong closure above and basically pushing the market to the upside. But then right here, if we mark out this high, you can see how we just wicked above, pulled back and closed really bearish. So after that you can see when we started going to the downside, we made a really powerful closure right here. So then after that we made a pullback, and then you can see how when we started going down, we actually swept this high with a huge wick, and of course followed by that we had an insane closure to the downside. So the wicks and the candlesticks that are sweeping or breaking structure are going to tell us everything that we know about. And you can see right here, for example, in the ranging market, you can see one high right here, you can see also a few different highs, and then you can see when the one box, if you were to draw one box in the market right here like this, you can see how we swept the upside then followed by that we swept the downside of the box. And that is basically something that we are going to look for in the market almost always. So what is actually going to be our entry and how are we going to manage the position? So you can see right here, when the market is going to the downside, when we either sweep a box low to the left or we retest a box if the market is uptrending like this, so we retest a fair value gap, we are going to want to wait for the last fair value gap in the market to get disrespected with a body like this, which is just a sign that the market no longer wants to go to the downside, because if it wanted to, we would come into the fair value gap like this, and then after that we would just kind of reject to the downside. But what we did is we disrespected it to the upside, so that is a sign that we want to continue looking for trades to the upside. Then right here we were making a move to the upside, we swept a box high or we either retested in a downtrending market a fair value gap or our box, and then after that what we did is basically we came down and disrespected this fair value gap, which means that the market is really likely going to go down. So what we do and how do we enter? We enter on a closure. When we get a disrespect of the fair value gap, we put our stop loss below the candle, below the body, and then after that we just kind of target to the upside at top of the box, or we target, for example, in a trending market, some kind of nice liquidity or the top of the structure. Okay, so here we are at the first example. So you can see right now, if we take a look at the market, you can see that we made a move to the upside followed by a move to the downside, and we just kind of ranged in the same spot. So all we do, as we already learned about, this is a ranging market, so all that we do is we need to mark out our box, and it's really simple. So we just take a look where the lows are and we take a look where the highs are, and we mark out the biggest high, so for example this one right here, and then we mark out the lowest low, which is in the market, this one right here. So right now we already have our box, which is this one right here. So all that we are looking for is from here we want to see a either move to the downside followed by a move to the upside, or we want to see the other way around, which is going to be a move to the upside followed by a move to the downside. So it's really simple. In the ranging market, we mark out the box of the range and we wait for the manipulation. So for example, what will happen right now, we are on the 50-minute time frame. We can scale down to the lower time frame, 1, 2 or 3-minute time frame, it doesn't really matter, and all you do is you wait for the entry. So for example, we can either see if we are going to sweep to the upside or to the downside. So if I fast forward the market, okay, so we made a pretty fast move to the upside followed by what we left a fair value gap, something that we talked about. So this is the fair value gap, and you can see right here this is the bottom of the fair value gap. And what did we do? We still didn't inverse that bottom of the fair value gap, so we need to wait for the closure underneath this fair value gap. So if I fast forward the market even more, let's see what will happen. So right now we are going again to the upside, and there it is. So you can see if I zoom in the market, we closed exactly below the fair value gap. So what do? We enter the short position, we put our stop loss on the top of the candle or the body as I talked about, and what do? We target the low of this range or this box, and let's see how is that actually going to play out to us. So this is a more than 2 risk to reward trade, so this is really good risk to reward. So let's see, in the end we are really close to the take profit, and there it is. So basically it took a bit longer to hit the take profit, but you can see how in the end, if I scale out back to the 50-minute time frame, you can see how we wicked to the upside, got a perfect entry right here, and all we did was we targeted the low of the range. Now most of the trades play out within 10 to 50 minutes. Now of course sometimes it's gonna take a bit longer, and sometimes some trades can maybe take 2 minutes to hit the full take profit, so it will always even out. Okay, so right here looks like we have an uptrending market. So you can see we came from the downside, we made a retracement. You can also see the beautiful thing that we just talked about, how the one box that was created in a uptrend just perfectly supported the price to the upside. Followed by that, we have a beautiful displacement to the upside with a powerful candle, and right now we made a new leg to the upside. So right now what do? We spot the one box. So right here in this whole move, you can see that we have this one box right here. So if we mark it out, all that we do is we scale down to the lower time frame and we wait for the market to come inside it. So if I fast forward the market, let's see if the market is going to tap into the one box. So as soon as it taps it, and there it is, we are starting to look for an entry. So the first thing that we do is we mark out the fair value gap. So this was the last fair value gap and it already got inversed, but this is where you can easily get tricked. You can see that it actually tapped into one more fair value gap and this one did not get inversed. So what do? We are going to wait for the disrespect of this fair value gap too. So basically we just kind of have to wait with our entry for this one to get also disrespected, because then that is going to tell us that we are for sure uptrending. So you can see we still didn't inverse it, barely, so we just kind of have to wait. So let's see, and there it is. So this up close, basically a bullish candle, closed above this fair value gap. So right now what we can do is we can enter long positions. We can basically put our stop loss right here or somewhere below. It doesn't really matter as long as it is below the candle that actually disrespected the fair value gap. And now of course the target is going to be huge because we want to target all the way up here. So of course we can target maybe 1 to 2, 1 to 3, and if we want to target all the way up here, we can basically expand the trade and wait for the whole position to play out. So let's see if that is going to be the case. So if I fast forward the market, you can see it beautifully hit almost 1 to 5 risk to reward. So basically you're seeing how simple it is. And before you leave the video, I want to also give you something for free. So also if you like the video and learn something new, make sure to subscribe to never miss another video. Also like the video, and also if you want to claim a free PDF checklist of this whole strategy, of this box strategy, go down there in the description and just basically claim it for free. Also one more thing is, if you maybe want to work one-on-one with me, you can go down there in the description and you can basically check out if there is still some spots left. So if there is still some spots left, you can apply, and I'm gonna check if you are a right fit for the mentorship, and basically you may get mentored by me one-on-one. So with all of that being said, I hope that you enjoyed the video, and I'm gonna see you in the next one. Peace.